All right, I got a cough, so bear with me if I have to start coughing. But here's a couple things I learned from playing around with options flow over the last couple of weeks. Um, so first of all, options flow is basically just like looking at visual images of what the options look like on like a delta chart or a gamma chart. So a delta chart tells you pretty much exactly like what the open interest is for all the strikes, like who's got what going on at what levels. And then the gamma is kind of more about like what is the actual effect on the market maker's requirement to dynamically hedge that. So just because you have a lot of open options in an area doesn't necessarily mean the price is going to aggressively move there or not. Sometimes the combinations of the way that the options are make it so that the price just kind of compresses out there as well. So number one, I found that options flow is kind of irrelevant if you don't have the market correct. So you can't just hammer something that has like a lot of out of the money calls and expect it to go there. You're going to have to go in sync with the market. So if you look at SPY right now, the issue with the last couple of weeks is that there really was like a range bound sort of direction. So beforehand you had to go long, 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 long on all the dips. So like, you wait for a dip. As soon as you get kind of a bullish candle, you go long there. Then you kind of profit out, wait for a bullish candle, go long there. Profit out as soon as it starts chopping around. Wait for a bullish candle right there, go long into that. That was a catalyst, etc. So that's how you go, and that's what Pete says too. But then you get this like enormous bearish candle here, and now all of a sudden there's too much selling action for you to really buy dips anymore. So what you actually have to do is you have to profit into very short rips. Like you could have gone long here as soon as you saw that this was a gap reversal. You could have gone long into there, but then immediately profited into the next resistance. And then you have to actually go short here, and then go long here, and then go short here, and go long here, and then go short here. It's very hard to switch, especially when you've been doing the exact opposite for that long. So when you're trading options flow as like hard targets for your stocks, good luck in this range. You're probably going to have to just take whatever you can get and just use the options flow as like an added edge. Hard targets probably won't work in a range bound environment, but they will work in a bullish channel environment. Second thing, let me see what else I want to say. When you are deciding how to structure your trade, you can do a couple of things. So for example, on something like Nike, and I took a lot of these trades as kind of experiments, and they might have been bearish charts or something like that, but I might have overheld them for specific reasons, because I kind of want to learn what happens with regard to the options chart and all the market conditions. Nike was one of them. I actually just took a little tiny loss right here instead of riding it all the way down through. So Nike, the entry was like maybe around here, maybe a little further. Nike wasn't necessarily in sync with the market at the time, but it had options flow all the way down to 70, maybe even a little bit around 69. So around 69 would have been a hard target, but the problem is the market is not bearish right now. So you can't expect to hit that hard target. But if we were in a bearish market, what you can do is instead of taking like at the money or like even in the money calls and puts and stuff, you can actually take an out of the money debit spread that actually ends up, when you're at your hard target, being deep in the money. So let's say your hard target was 69 because you were hypothetically in a bearish trend environment, and your entry was up in here. You could actually take a put debit spread, like a 71.70 put debit spread. So by the time you hit 69, you were definitely deep in the money on it. You were through the short strike. And then you just calculate kind of what the return on that is. And if you're getting it for like 25% credit, then your payoff can be over 100%. And the benefit of this is that you can actually just like sit on this during pullback, because as long as it eventually hits target, you're going to make that money or more. If this hits target in the last week of the expiry date, you might be making like 150, 200%, something like that. So that's the benefit of using an out of the money debit spread. You could just use something in the money, but the problem is if you want to sit on it for a really long time, you're hoping that it's rushing through the delta, and then the premium that you're paying isn't making up for it. Or you have to take profits kind of like down here. You can't ride it all the way. So whether or not you're going to use straight calls or puts, and whether or not you're going to use an out of the money debit spread depends on the market and the probability of the stock. Same thing on the upside. So something like SQ. So with SQ, I've erased everything on it, but you've got this like line of support right here. Things were super bullish at this time. My entry was here or here, I can't remember, maybe here. And I took a 95 105 right through there. It only topped out at around 80%, and I overheld it and just scratched it out. But the idea on this is that even if I get a dip down to here and then a bounce back up, as long as I hit target, I'm going to be making money. In fact, the longer I sit in the trade, the more my payout is. Whereas if I just took straight calls, I would have to hope that this thing ended up to target and that the extra premium I paid on the calls didn't negate that. Unless I'm taking deep in the money calls, but then my risk reward is not necessarily as beneficial either. So I like a deep, like a far out of the money spread that's targeting certain high volume DEX levels when the market is trending. When the market is not trending, this doesn't work. So, for example, not NOC or NUE. I think that was just a timing issue. So yeah, we had NOC and NOUE. These were both shorts that I took. But the problem with those is that I was disjointed with the market. So if you look at SPY right through here, I was entering these things like kind of like here and here when I should have really just been taking them here. And then whatever I can get as soon as I get down towards the next support, I'm out. So those didn't work out too well. But I was thinking maybe that if I took these types of trades, it wouldn't matter what the market was doing. They would just hit target no matter what, so long as the put open interest was still there. That's not the case. That doesn't happen. So, like, options flow is not magic. It's not going to make your chart hit target no matter what. Another example is ANF. So ANF down on bad guidance or bad sales targets or something like that. I don't know. Bad news catalyst right through here. Entered it through here, but I took actually a 125 120 because the options flow was all the way down to 105. Like there was just puts all the way down there. So I thought, you know what? I'm just going to take it all the way down there. The problem with this one though is I bought it at the bottom of SPY. And then SPY bounced, pulled it back a little bit. It's probably going to hit there. But then I had a weekly one because I got too greedy. And I took I took like a 125 120 for like $1 or something like that. I thought the payout would just be outrageous, like 300%. I was very excited about that. That's not going to work either. Mostly because there was like a lot of upsloping algos through here. You'd be surprised though if the options flow is good, it will break an algo, but it's not going to break an algo and go against the market that long. So NF was okay. I did the same thing with Lily, so I had two kind of experiments going on here. So Lily, my I actually had a 725, 720 on Lily. Same idea. I thought I could just take a weekly PDS and just target like the bottom range of where the flow went to, where the DEX chart, where all the high open interest was, which was down to like 700 or 710 or something. And I thought, you know what, if I just take a PDS that is in here for like pennies, then my payoff could be monstrous. But I have to basically guarantee that the market's going to be on my side for the entire week. Once again, I think there's like an algo level here. There are resistance levels on the way down, but if you have the flow, it will crack those levels in the right conditions. So that was another kind of mess up. I think I got 30% back at the end of the day on Friday or something through there. So Lily and ANF, both experiments to see if I could just take something with a lot of options flow and just let it kind of hammer all the way down no matter what the market was doing. That's not the case. But what you can do is you can take something that's a little more in the money. Because if I took it through here, if I just took like one strike higher, so instead of like a 725, 720, if I took like a 730, 725, or even like a 735, 730, and got like 60, 70% out of it, which is an excellent win, that would have worked out actually quite well despite the market. Same with ANF. If I just had it one or two strikes higher, my percent that I would pay based on the strike width would be closer to that like typical wiki 50%, but the probability because of the options flow on it would be significantly higher, and it would kind of sluggishly bottom out a long time, so you had a lot of opportunities to take profit. Like I could have taken like 30% here, 45% here. I could have even at the end of the day here taken a lot, like maybe even here or here I could have taken maybe like 80%, who knows, instead of like 2 or 300% that I was looking for. So make sure that when you're using options flow as targets, you understand the context between the market and what it's doing. If you are trying to trade against the market, like a day trade, some sort of catalyst or something, and you're going to hold it longer for a day, you got to go a little more in the money. You got to go classic wiki. Now, here's some examples where it did work. Take a look at this. If you are on a bearish trend day and it is near the end of the week, options flow and lottos work tremendously well. So here's STZ. Dave noticed this one in the chat. The premiums were actually quite low for it on Friday. It had some sort of bearish catalyst on STZ. And on SPY, it was this like juicy bearish trend day. And even though it kind of bottomed out, it didn't rebound, right? So we had STZ. And this thing just kept going and going and going and going and going. On this one, the flow went literally all the way down to 180 on Friday. So the last high volume or like high open interest strike on the DEX chart was exactly 180. When you have this situation where the market is bearish and you have access to like really short term lottos, things like that, you can actually expect your target to hit. Like you can expect close to the entire range of the open interest on the out of the money puts or calls to be hit. So this one was like a 350% winner, something outrageous like that. That's when you can do kind of like against the market or like really far out sort of targets, and you don't need to use a debit spread on this one because you're just going to hit it right away. Here's another example. NVO yesterday. Beautiful one. Some bad news with GLP drugs, like their sales weren't going to be as high or something like that. If you look in through here, marked out in this position was the strangle that I took near the start, and the red lines are where all of the open interest was on the puts. The green lines for me were just where like my break even at end of the day would be on my strangle, which I took kind of like right around in through here, an 80 strike straddle. So on this one, even though you didn't get the VWAP check on the way down and you're expecting the slingshot back to VWAP, the options flow was so bearish and the catalyst was negative that despite this low volume kind of like gap up in the market, you actually did get close to 100% profit on this one. I think I took like 50, 60%, something like that. Like I think I took profit down around in here because I wasn't sure because the market was actually gapped up. But if the market was in my favor, I would have probably just held it until almost end of day. That's another one that had a lot of bearish options flow. ONON, post earnings, very strong. Here's another one that I took very strong. Now these are the DEX levels. So at the 5750 strike, the 58, the 59, and the 60. All three of these had a lot of very high open interest on calls. And this was post earnings, very strong earnings reaction. The relative volume was a lot, like double, 2 or 3, something like that. And then we got this like little dip down here to VWAP. But these strikes, when they're high delta strikes, often act as support and resistance. And the reason I believe is because the market makers have to dynamically hedge. So the closer you get to these like open interest call strikes, the more you're likely to just bounce off and go up to the next level. The midpoints on them also work. So between 58 and 59, you'll have some action around the halfway point because you're either going to get gamma squeezed up to here or it's gamma squeezed down to here. Now with ONON, you have this post earnings reaction, and then you get this little dip through here. And even though this stock is quite strong, this dip is not significantly high volume, and I see that it is right off of that bottom high delta area, and we've got this compression break. So either I'm going to be getting right through here, if you see this, either I'm going to be getting a retest of this line through here, this trend line break from this point. So I'm either going to get a move down to here or a move up through to like the next higher level of delta. Now, you can't expect this thing to move like crazy because we already did gap up, and because there's overhead resistance at these areas too, like up and through this strike. So as long as I have this level here as a target and this level down here's a target, my entry kind of in the middle. This paid off 100% in either direction, and I took a nice 100% right here at this high delta strike as well. So on Fridays, they work really well for day trades, so long as you understand that you're going to be using lottos or strangles or straddles. You have to look at the probability of them hitting like upper end strikes, bottom strikes, all those types of things, and not compressing out. Now, what else do I know about it? Yeah, okay, so here's the next thing. Just because you have a lot of open interest at a level doesn't mean it's going to stay there. Here's what happened on ANF. So as this thing dropped, but then you got this like little double bounce and things kind of floated around all shitty like and whatever, and the longer the time went on, the more I was seeing in real time, because I kept refreshing it, these lower levels down here on the put open interest start to just drop back. So they would like cut back, cut back, cut back, cut back, cut back until they were like quite small. So don't expect these don't expect these like high open interest levels to always necessarily stay there, especially if what you think should have happened doesn't happen. So ANF, I guess, the open interest, they were expecting some of these algos to just break through. But then when they didn't, the probability of these levels getting hit dropped, which means that like the amount of people who still have open interest on those are dropping too. And remember, these were all like weekly puts. So there's no reason to stick around on these. Now, if these were like 1 month puts or like 90-day puts and they weren't earnings, then you would probably see them kind of stick around. Adobe was another one right through here. So even though the market was actually bouncing and ripping, and then you get down to here and then you get this rejection on SPY this day, that little candle right through there, Adobe had puts all the way down to 400. And then sometimes like a little bit around like 390, etc., but all the way down to 400 it had puts. So if your entry was here, which was like it's kind of like a mini pullback, because you have this compression break, but it was almost too much of a gap down, and the market was still kind of bullish. And then you have this little compression break, or not compression break, this little pullback. Your entry is kind of like around in here somewhere. You can ride this down to close to the 400 level. But remember, the market is not trending bearish, so you can't expect to ride it exactly to target. As soon as the weakness on it starts to fade, or as soon as you start hitting the bottom of the range on SPY, you got to get out. If you look at it, this level right here, the lowest day, the day that it bounced, that's this day, the gap down day. So if you're in Adobe and you're expecting 400 to hit, and you get this gap down, but then support hits and it starts filling the gap, you should get out. You should take profits. Now, if we were in a bearish trend in the market, just sit on it, because maybe you bought, like, I had the February 7th, I had like a 410, 405 PDS dated of February 7th. It paid 70% profit, and I entered it here. But if the market was still bearish, I would just say, cool, let it bounce, let it get closer to the ADMA, let it reject off that, let it hit target. Maybe by that time the target's a little lower. Who knows? Or take profit, essentially, if the market is not bearish. So that was Adobe. A couple of other mistakes too. NOC, your TA still has to work. So NOC, I took a short here, a PDS, a 2-week one, because I thought, I don't know, I'm not sure exactly how to use bearish option flow when I'm shorting, and I'm not sure the time frequencies I need to use too. Maybe my hypothesis was that I didn't need as much time on them, because when your short works, it happens a lot faster than when your long works. So I thought, you know what, I'll just chop 2 weeks off. They probably have elevated IV because the VIX is up anyways, because we're like in a shorting environment. So maybe I only need 2 weeks on this thing. The issue with NOC though is that we hit an algo line here, and we hit the bottom of the channel there. So it's just like kind of like double point. But this channel could still capitulate down, and you could take profit all the way down to there. These red lines are where the put open interest was. So my target was actually closer to 440. I was greedy as hell. Like, I'm trying to get like, I don't know, like 150, 200, 300% profit on these types of trades. I'm assuming that they're just going to hit their end target. But the issue with this one though is, even though I entered at the top of the range, we had a nice little sector rotation on this one too. So it just didn't work out. So like little sector rotation, you can see how the sector was like kind of weak all the way in through here, and then all of a sudden the sector just got wicked strong through there and ripped. That was back when LMT was a good short. What do you RTX, that all bounced. GD bounced. Um, LHX, they all bounced, right? So that's all the same kind of industry right through there. But they all had bearish flow all the way through to there. So sector rotation will still get you. If this was a bearish trend market, then I would have had a longer dated out of the money PDS, and a lot of them might still have value, and I would just sit on them and hope they kind of return and continue back down. But we don't have that in the market right now, right? And then NUE, here's another one. I think I just hit off the AVWAP from this like crazy COVID low, so it hit support pretty hard. But even once again on these, like if the market is actually bearish, then your PDS is way out of the money, and it's long dated. It's like 40 days out. So your chances of this coming back are quite high, like bouncing off, continuing back down are quite high. And let's say you didn't take profit here, well then you get another chance to take profit down here, and because it's a put debit spread, you're taking 20, 30, 40% more profit this time around because your short strike has been eaten up and you're still in the money on your long strike by the time you hit target. So those are some mistakes I made with options flow. Essentially, you can use options flow as targets for your stocks and as an added edge, but you cannot expect those targets to necessarily be hit. And so you need to structure your trades according to what the market is doing. If you are in a back and forth market like this and you want to trade both directions, you're going to have to take profits based on where the market is, regardless of where your stock is. If you are in a trending environment, you can hit hard targets, but then you're going to want to have long expiry positions. And I actually prefer out of the money debit spreads because you have a hard target in this situation. This isn't a discretionary exit, which means that you can always aim for your hard target, which means that the longer it takes to hit your hard target, the bigger your profit is. It's like a reverse. Well, it's kind of like a, it's kind of like a bull put spread, but like a little smarter, as long as you have the options flow on it. And then lastly, if you see like a crazy moving stock, like here's one, RPRX, some sort of stock on its own page, insane volume, monster catalyst, the market isn't necessarily holding it back. It's maybe a Friday, or it's like a lotto type day or something. You can use this as targets as well. So on RPRX on this day, there was calls at 27.50 and there was calls at 30. So as soon as you get more than halfway to 30, your likelihood of hitting that target is quite high. Because if you have the same amount of open interest here, same amount of open interest here, and these are all like long dated. And this was, I don't know, post earnings or some sort of trial work. It's biotech, right? So it doesn't really follow the market necessarily. As soon as you get past this halfway point, like in here, like the 28.75 and through here, you're now on the side of the gamma squeeze, pulling you up into the 30 strike versus pulling you back to the 27.5 strike. So as soon as you start to see some kind of support hit right through there or something like that. On this day, this stock had so much relative volume and was so strong, and if you see this like grindy sort of just non-stop pattern, that even though you didn't make it to target because the day was actually quite bearish on the market, you can actually just take like, this was January, right? You can take just February 30 calls. It's like out of the money February 30 calls. And because they're so far out of the money and you're so close to target, by the time you actually hit target, there's barely any theta coming off of it. And also, you just made 100%. Like if you entered right around through here, around the midpoint, and saw it kind of coming up through here, from here to here on the 30 calls for February, even though they were out of the money, was 100% profit. Which means that you can just set it and say, hey, it either works or it doesn't. You don't need to enter these like deep in the money high delta calls and then watch this thing like a hawk, and as soon as you see weakness you're like, shit, I'm out, I gotta take like 20% on this thing. You can just slam the 30 calls, and if it doesn't work, it doesn't work. You have until February for this shit to work. And you don't have to discretionarily manage your exits. So options flow is a very powerful tool. But just like anchored VWAPs and just like everything else, you have to read it, you have to look at the probability of things, and you have to structure your trades. Structuring the trade is the most important part, I believe, about using option flow as an edge. Hopefully that rant helped you out. Hopefully I was a little transparent with some of my wins and losses, kind of what works and what doesn't. And going forward, I'm going to be even more successful using this. It was tremendously effective during the last SPY rally. If we get another bull rally like this, I'm going to be exclusively using options flow because I was able to ride some of these targets up to ridiculous levels, like 180, 200% winners, etc., with a very high quality or like a high level of probability. And then once we get into a bearish market as well, it's going to help me really take the entirety of those moves. You know, those moves where you get these giant candles. And you're like, when's this thing going to stop dropping? And you're just scared shitless as you're riding this down. You're like, just take $1 and I'll get out. Because who knows when it's going to bounce like a banshee. Well, the options flow can tell you where to get out. And you can take some truly tremendous profit on some of these. But you have to understand the context and you have to be smart about reading the charts. I'm using predominantly delta charts for directionality, not gamma charts. Delta charts appear to work better than gamma charts for this type of trading, but maybe not. I don't know. Maybe the gamma might work too, but I haven't looked at that. So that's it. That's the video.